Webinar there now, okay? Good morning, everybody. Just waiting for some people to arrive there now. They're clicking in nicely there now. Thank you very much. We'll just give it just one more minute there before we start. It's just a minute past 11 there now, so. Rose Tierney, our tax consultant for this morning, is going to have to get a drink of water for herself. So she'll be back any second and we'll kick off then. So we have still people joining as it happens anyway. So we're live now, Rose. I'm just waiting for the few last people to join here now. Just a couple more to come in and then we'll kick off. Okay, I think we'll make a start now if everybody's okay with that. So look, you're all very welcome to this morning's webinar, the seminar on tax and social security implications for cross-border workers and employers and job seekers. And the webinar this morning is in collaboration with Letterkenny Chamber. My name is Paul Clancy, I'm CEO of the Chamber in Derry and EURES advisor for this region. And we're delighted that so many of you could join us today from both the Derry and Letterkenny Chambers. And I'm really looking forward to our session this morning with Rose Tierney of Tierney Tax Consultancy. I know we had a seminar earlier in the year, and the amount of questions that came through to Rose, we just ran out of time. So we decided it'd be a great idea to have another one this morning. So just a little bit on Rose. Rose is a chartered accountant and chartered tax advisor, qualified in practice in both the UK and Ireland. And after many years in practice in London and Dublin, she set up Tierney Tax Consultancy. And having advised businesses from large multinationals to sole trader startups, Rose now uses that wealth of experience in assisting individuals and business on tax matters arising in both jurisdictions. And it's an amazing, challenging time to understand the implications and tax implications now with Brexit and everything else. So we're delighted, Rose, that you're able to join us this morning. If you have the option to text questions to us during the webinar via the text icon at the bottom of your screen, and we'll do our best to get to all your questions with Rose. And if you have questions that are not answered during this webinar, we will reply to you after the meeting. But before we make a start, could you please put your microphone on mute? This will ensure we minimize interference. And before I present some slides, just on the EURES cross-border partnership and what it is and what it's about, I'd like to thank Joe Lavery of EURES and Tony Forrester, CEO of Letterkenny Chamber, whose members are a great support of our EURES webinar. So if I can just share the screen now. 1 second. So I hope you can see that. Rose, you might nod your head as long as people can see that. That's great. Thanks, Rose. So look, we've done the welcome bit there. So just a little bit on EURES cross-border partnership. We're helping the cross-border job seeker, worker and employer. A little bit about who we are, what we do, and where and when. So European Employer Services is what we're about, and EURES is made up of two arms. One is the transnational, to help people get jobs or employers to get workers across the EU, or alternatively, EU workers to get jobs here. And the second part of it is the cross-border bit, to help cross-border workers, employers and job seekers in the border region of Ireland. That is us, the Cross-Borders Partnership Ireland, Northern Ireland. So what organisations are part of our partnership? Well, we've the Irish Congress of Trade Unions, and we've IBEC, we've ourselves, Dundalk Chamber, Employment Affairs and Social Protection, the Department for Communities, and CBI. And we have advisors based in the partner organisations who carry out work on behalf of the EURES cross-border partnership. And what do we do? Well, we have three target groups. We have the cross-border worker, we have the cross-border job seeker, and the cross-border employer. And we provide information to cross-border workers on employment-related issues such as taxation, like for today, national insurance, social security, and secondary benefits, etc. And we help job seekers from both sides of the border widen their net in their search for employment. And finally, we assist employers by providing them with access to a larger pool of labour. Advice is also provided to employers on a range of cross-border recruitment issues. And we cover the whole of Northern Ireland and the border counties of the Republic of Ireland. And you can see the map there of the counties that we cover. So when we have activities ongoing throughout the year to support employers, workers and job seekers, including cross-border job fairs, and these have obviously been more challenging now in the current climate that we're in with COVID, cross-border tax information events like today and the one we've done before, and cross-border employer support events. And we're an advisor network, and information material and sessions are always available on our website or on our social media. So our priorities are addressing skill shortages and employment bottlenecks in the border areas, provide clear factual information in these unsettled times, and support our target groups of employers, workers and job seekers with cross-border supports. And that's really what EURES is about. So that was a whistle-stop tour through EURES. If you have any particular questions on those, we can take them afterwards, but I'd like to just hand over to Rose if I could now. Rose, I'll just stop sharing the screen here and let you start sharing. So once again, thanks a million, Rose, for joining us this morning.
Share screen button on for that. There it is. Is that clear?
Yes, that's perfect, Rose. Yeah, that's perfect.
Okay, well, yes, yet another whistle-stop tour through cross-border tax for the employer and the employee. There's been a couple of changes since the last time I spoke to this group, and so I'm going to do a little bit more emphasis on the employer this time as well. So anybody who maybe has logged into the Dundalk one a little while back, there'll be a little bit of repetition, but hopefully you'll pick up something from this one that wasn't on the last one. Paul has already gone through sort of the EURES part of this, but what we're going to cover today is some implications of COVID-19, Brexit and the uncertainty. I'll just skip across the EURES slides there. So I suppose today's message is everything's in flux the whole time. You'll see that on the slides that everything keeps changing. Things are announced and sometimes they're withdrawn, and before they're even implemented. There's constant changes and been constant complexity for the employer and for the employee throughout this year, and particularly for those in the cross-border region, because there's still a lot of uncertainty in certain businesses. They're closed one minute, they're open the next, and a lot of employees very concerned. Am I going to get paid this month? How's the employer going to pay me? So there's a lot of issues there for both the employer and the employee. But most of these rules are temporary, and I suppose is the thing to take into account. There are temporary rules in place at the moment that facilitate both the employer and the employee. They won't last forever. And there's some things coming out of this now that maybe that we should be looking at addressing on an ongoing basis permanently going forward. And maybe as a group, EURES could take some of the baton there as well in relation to that. So we'll have a look at that. I suppose the issues for workers go back to what we discussed before. So there's the residency of workers, the residence test, some relaxations there, and the cross-border workers relief. And then there's been the various wage subsidy and furlough schemes, and which had an impact on a lot of employers and employees. And then there's the implications, the long-term implications for PRSI, state benefits, and pensions, and things like that. So we'll have a look at those. So we covered this the last time, but just a reminder, the personal residence test in the Republic, the normal one is 183 days at any time during the day. So if you spend 183 days at any time during the day, with at least 30 days in a year, then you are going to be resident or treated as a resident of the Republic of Ireland under domestic rules. The second rule is the 280-day test or the look-back test. So they do the test over 2 years. So 280 days at any time during the day over 2 calendar years, and you're a minimum of 30 days in each year, then you're resident in the second of those 2 years. So spend 280 days in 2019 and 2020 in the ROI with a minimum of 13 each year, then you are resident in the ROI under domestic rules for the second of those 2 years, 2020. But because of COVID, a lot of people couldn't move around as they would freely have liked to. So the revenue considered this was a force majeure circumstance, in other words, outside of your control. And if you were unavoidably present in the state on a day only due to the COVID restrictions or the inability to travel or the lockdowns, then they would take that into account in assessing somebody's residency. So people should keep a very good track of their movements in terms of where they were and what days they worked in the ROI, what days they were in Northern Ireland, and keep good track of that to make sure that they have, suppose, their facts and circumstances very clear should there ever be questioned. The statutory residence test in the UK also created issues too, because the normal test there is a lot more complex than the ROI test. So it's 183 days of midnights, I should say, in a tax year. It's 6th of April, 5th of April. You could be considered automatically resident for that year. But there's lots of other tests as well. There's all those ties to the UK. So you can be resident in the UK or in Northern Ireland with a lot less days spent in it, depending on how many ties you've got with employment ties, family ties, accommodation ties. So it's far too much detail to go through a little seminar like this. But the statutory residence test goes on for pages, about an inch thick. So we won't be going through that today. But the COVID rule in relation to that test was there's a relaxation there as well. And that relaxation hasn't changed from the last time we looked at this. So people whose circumstances meant that they were quarantined or unable to travel or advised not to travel or unable to leave the UK because of closure of international borders, or the employer asked them to stay temporarily in the UK, or who were required to come to support a relative and had to isolate or whatever. But whatever the reason was of COVID related, then the HMRC would take into account a disregard of 60 days in working out the test for residency in the UK. So you could disregard 60 days of that test in calculating the number of days spent in the UK, to see if that facilitated you in claiming one way or the other whether you were resident or non-resident, your normal position. That 60 days hasn't changed. There's been updates to that guidance several times since, and it still hasn't changed. So still 60 days you're looking at for the 2021 tax year. Cross-border or trans-border workers relief then is an ROI tax relief. So if you are resident in the ROI normally and you have they call a foreign employment, not just Northern Ireland, it could be in other countries, other treaty countries as well. And you commute at least once a week to that employment back to the ROI, and you pay tax under that employment, and it lasts at least 3 months, and it's not what they call a proprietary directorship. In other words, you're not an owner, manager of the company with more than 15% of the shareholding. Then the idea is that you don't pay any further tax on that employment in the home country ROI if that's your only source of income. So it's not full relief if you've got other sources of income like rental income, investment income, or if you're jointly assessed with a spouse, because it's based on a formula, and that formula then is skewed if you have other income, because it's the foreign employment income divided by your total income. So in a lot of instances, I always advise people in the seminars to have a look and see if they're better off being separately assessed from their spouse in the ROI to make sure that they maximise the relief available to them. Now, under COVID, this had an implication as well, because certain conditions there that you must commute at least once a week for duties of employment or carried out in the other jurisdiction. You pay tax in the other country. And of course, if you weren't able to travel because of the restrictions, then that poses the question: you could claim the relief or not. So what the revenue said was that, if you were required to stay in the state, and such days spent in the home state wouldn't preclude you from claiming the relief, it'd still allow you to claim the relief, even though you hadn't technically satisfied all of the conditions of the test. There's also implications then across the board in other areas as well, like redundancy. So the UK statutory redundancy test is in place there, and if you were short-time working, except for your furlough, that you could claim redundancy from your employer. And the same in the ROI, there's this ability to claim if you're in short-time layoff or whatever, an ability to claim redundancy in the ROI. And if extended a relaxation to that rule for the employer, which last relaxation was up to 30th of November, but now it's been extended out to 31st of March 2021. Now, the employee can't automatically claim redundancy from the employer, just if it's COVID related is the reason for the layoff. So if they're short-term or reduced working hours, then until March next year, they haven't got the automatic ability to claim redundancy from the employer. Now, we are seeing more redundancies coming through from various different businesses. We've done a reorganisation of now assessed what the business is going to look like or could potentially look like going forward. And there have been a lot more redundancies than maybe when we had a seminar like this a few months back. And so we're definitely seeing more coming through. Some of that was as a result of the ending of some of the reliefs and schemes that were available for the employer. So it was inevitable that when the monies were withdrawn, there would be some redundancy, and that has panned out like that, yes. So the subsidies that I'm talking about would be the TWSS. So anybody who's, I see on the name of the list of people that will be attending these seminars, there are some advisors and accountants and that out there. So you'd be very familiar with the complexities of these schemes, the TWSS and the UK furlough scheme. They're all very good and very necessary in terms of making sure the employer could pay the employee, but the complexity, particularly of the TWSS, has just meant that there's all sorts of complications, both for employer and particularly in cross-border context, which I'll get into. So just a summary, as a reminder of what they were. So the TWSS, the temporary wage subsidy scheme, was the employer was reimbursed 70% of the net wage of the employee, and it was processed through the payroll. The employee could work throughout that. They weren't restricted like the UK furlough scheme in the beginning. But it did mean that there was no tax USC or PRSI paid by the employee, and no PRSI paid by the employer on the subsidy element. Now, the employers were encouraged to top up to normal net wage, but in that itself, there was some complexities there depending on the calculation method. And there's also then an end-of-year adjustment to tax credits for the employees, so they're not getting away with not paying tax. The subsidy that they received is taxable, and they will have to pay tax on it, tax in USD at the end of the year. So I'll come on to that in a second, how that's going to work. On the UK side, then, there was a UK furlough was based on 80% of gross wage, which is a lot simpler to calculate. And there were some restrictions on the employee being able to work in the beginning, but from July onwards, that was relaxed, became more flexible. And the employers were encouraged to top up, but there should be no adjustment as such required at year end in relation to that, because the gross wage was the facility or the method of calculation used in that particular scheme. So in ROI then, they moved on to the EWSS, the Employee Wage Subsidy Scheme, from 1st of September, and that will run to March 2021. And it is taxed through the payroll, so there is tax in the USC being deducted. Now, there will be tax implications where the employees avail the TWSS, and there will have to be tax collected. The UK furlough scheme then, it only ran to October, and the percentage is reduced from 80 to 60%. And then a new scheme was announced for closed businesses and open businesses, and then it was withdrawn. And then they reinstated the old furlough scheme, and it will run to March next year. And again, the percentage went back up to 80%, but you must have been on the payroll by 30th of October. And they'd announced a nice bonus scheme for the employers to retain jobs, and that's been scrapped as well. So it's like depending on what time of the day you listen to the news, you can find out what's going on in the world. So it's been very difficult both for employers, employees, advisors to know what's going on, and all that uncertainty just leads to worrying and what comes next, and particularly for the employees. The TWSS impact at the end of the year, I know even in the businesses that I'm dealing with here, it's just a big worry for the employee. What am I going to do? I'm going to have a big tax bill. Now, Irish Revenue did announce that you'd be able to pay it off from 2022 onwards through your tax credits. Your tax credits will be reduced. That just sort of stretches it out over a number of years. So the way that it normally works for cross-border employees, that when you have earned your ROI employment income that you live in Northern Ireland, then you still have to file a return with HMRC to return that income. But what happens in the 2021 year is that for the 2020 period you worked in ROI, you didn't have much tax or USC deducted. The TWSS was claimed for you. So you've got a very low tax credit available to your credit against your equivalent UK tax on the HMRC return. So that poses a problem and a worry for a lot of cross-border workers. So where the detail lies in that is that where the calculation method is that you take double taxation treaty credit, tax in the USC paid in ROI as a credit against the HMRC, the tax due to HMRC in the UK. But the rule under the treaty between Ireland and the UK is that the double taxation treaty credit is based on the Irish tax payable, not paid, but payable under the laws of Ireland. So even though you didn't have the tax deducted during the year, during 2020, the tax of the USC, it was payable because that income is taxable and is payable after the end of the year. So you are allowed to take into account not only the tax that was deducted on the USC, but the amount that you still owe to the Irish revenue for the purpose of your 2021 HMRC return. That's all fine and well if you can work it out. So the way it's going to work in the South is that there's going to be an end of year summary from the Irish revenue available in your My account on Ross for the employee. And that should show not only the tax paid, but also the tax payable. So the amount that you still owe. And that would be really important to use in calculating the tax that you owe to HMRC, if any, when you're doing your UK tax return. So the TWSSA is subject to tax in USC, but not PRSI at the year end. And you do have the option then, so you've now sorted out that you'll have the figure hopefully available to know how much you still owe in working out your UK taxes. But what about paying off the liability you owe to the Irish revenue? Well, you have the option to pay it off in one lump sum if you like at the end of the tax year, or they can do a deduction over the employee's tax credits over a period of years starting in 2022. And so, okay, well, if I go with that second option, spreading it out, which might be easier, then what happens when I go to do my UK HMRC return in the next number of years? Because the spreading out also has an impact for your UK tax return purposes. So you say, for example, you pay extra tax in USC through the reduction of tax credits in 22 or 23, then the tax figure available as your double taxation treaty credit, you'd have to recalculate the amount. It's not just the amount from your end of year summary, there's some of that related to prior years. And it just gets very complicated. For somebody who isn't into this at all, it gets very complicated to work it out and do your own tax return. And if you don't make that adjustment, then really your tax credit could be overestimated and you could have underpaid tax. So there's nothing like making it simple. There's one thing certainly hasn't been simple is the TWSS system that they introduced. Irish Revenue decided to administer it, and yes, it was very necessary, but by God was it complex, and it's still creating complications. So wouldn't it be nice if you're actually provided with that figure? Since the Irish Revenue administered this whole scheme, wouldn't it be nice if they provided you with the figure for each year that is available as your double taxation treaty credit? Now, there's a thought. They have all the information. They can provide it to you in your end of year summary, in your end of year statement. So why not ask for that? So what I'm suggesting is if you write a letter, if you're in that position and you're going to need that information for your UK tax returns or for your clients who you're preparing returns for, why not ask them to provide it in the end of your statement? Write them a letter. And I'll share that letter with Paul and Anna, and they can circulate it to the list of people who are on the seminar today. It's just something very simple, like if you're a cross-border worker, you live in Northern Ireland, work in the ROI, and since the employer had to claim the TWSS during the pandemic, you're finding the calculation of the double taxation treaty credit very difficult, but it will be equally as difficult in future years. So you request that the tax and USC payable figure, so payable for the year in question, which is allowed under the Article 21 of the treaty, is made available to you in your My account, end of year summary, for the years 2020 to 2025. I mean, they have the information, it just has to be provided. So I would request that, or suggest that people would actually request that from revenue. And it should be available, made available to taxpayers. It shouldn't be made this complex. I don't think so. That's my view. There's another recent announcement as well, is that the Irish Revenue announced that the employer can, they're not obliged to, but they can, pay the employees underpaid tax in USC arising due to the TWSS claim that was made on their behalf. And it won't be treated as a benefit in kind. So if the employer says, okay, things are doing a bit better now, so we've gathered up a few pounds, and what we're going to do is, we know you've got tax liabilities, we're going to help you pay those, then they can do that without triggering a benefit in kind. So if the employee is getting an end of year statement in a My account showing the amount of tax in USC still payable, I'm assuming that all relates to the fact that TWSS was claimed, not because tax credits were shared between spouses or whatever, then the amount of taxes paid in this way can be paid by the employer. It's not going to be tax deductible for the employer. That's the announcement that was made. The employee can either be reimbursed the amount that has to be used to pay the taxes, and they pay it themselves through the My account or RevPay, or the employer can process it through the payroll. Now, some payroll packages might accommodate this. I just checked on our own one here this morning, and it doesn't seem to have that facility at the moment anyway, but it may be updated. Or the employer can do it through us. So there is a facility there for the employer to pay the taxes on behalf of the employee. Now I can hear, almost silently hear some employers going, oh no, please don't tell them that. And then employees go, oh great, we're going to look for that for the employer now for a Christmas bonus. But yes, there's a conversation to be had there. So I think that in some ways it's a welcome announcement. Other people might take a different view. But I suppose it's useful to know that the option is there anyway. What happens longer term then in relation to all these schemes? So if we deal with TWSS and state pension and benefits, those who are receiving the pandemic unemployment payment or the TWSS through their employment were not paying PRSI or being credited it initially. So a new act was introduced, the Social Welfare COVID-19 Amendment Act, and those who received TWSS or job seekers for COVID-19 are now deemed to have made a social insurance contribution for PRSI purposes. So that contribution will be attributed at the same rate that they previously would have paid. So if they were a Class A employee, it'll be a Class A credited or deemed contribution for them. And that should minimise then the impact on their social welfare record going forward. So for the purpose of state pension or claiming social welfare benefits, they should have a complete record for 2020. It shouldn't be the case that they have gaps in it due to the fact that they were on the PUP or the TWSS or the job seekers. So that's a welcome move there in relation to that. There are issues for employers all the time too. So I want to concentrate a bit on the whole issue of the cross-border worker and remote working that's been going on. There's constantly this obligation to set up a payroll for the employer. And a lot of people, I suppose, questions that sort of are sent to me at times. People think that this is some sort of discrimination against people on the Northern Ireland border. But I can assure you that it's in every other country nearly in the world, that where you have a jurisdictional line, and then what you have is different rules on either side of it. And when an employer sends an employee to work on the other side of the border or recruits an employee on the other side of that border, there are usually local implications for the employer. So the issue is with the employer, not the employee. And it's the employer's obligation to set up a payroll in the other jurisdiction if they don't meet any sort of treaty reliefs or any sort of concessions that are available. There's also impacts, I suppose, on from the employment contract point of view. There's law that determines where the employment contract should be drawn up, and I'm not a legal expert here, but it can vary between countries. So you have to look at that as well as to whether or not there's an obligation to set up a different jurisdiction's employment contract to cover the employee. And the whole issue about remote working policies, a lot of employers were advised in the beginning of this pandemic, so we didn't know how long it was going to last, not to twiddle around with your working policies or your employee terms and conditions, just to wait it out and see what was necessary. But at this stage now, it's been going on that long that it is necessary for some employers to now review their policies and put some procedures and policies in place so it's very clear for both employer and employee as to what the procedures are and what the conditions are in relation to employment because of the changes that have had to happen, which have been mostly outside of our control. So for the obligation on the employer then, it's all about setting up the payroll. A bit of frog in the throat this morning. So the employer, so some mistaken assumption sometimes is that the employer and the employee can decide between them where the payroll is operated. Of course, that's not what the rule says. It's always about where the duties are carried out. So if you live in Donegal and you work in Derry, then the duties are being carried out in Derry. So that it's a UK employment issue as to whether or not you need to set up a payroll in the UK or Northern Ireland for that purpose. Another mistaken assumption is that you can elect which country to set up the employment in. Well, there's no ability for employees or employers to elect to be taxed in their home country. Again, the rules sort of set out in the tax law is that an individual is taxed personally in their home country, but the employment taxes are deducted when the duties are carried out. And so they may well have a dual tax obligation in that regard, and you look to the treaty for relief to make sure they're not doubly taxed. And then another mistaken assumption is that it's based on the residence of the employee. So you're a Northern Ireland employee that an ROI employer takes on. Oh, well, sure, we can pay them in sterling and we'll put them on the Northern Ireland payroll, even though the duties on the ROI and the travel to work in the ROI. That's not the case. The residence is only relevant when you're looking for a treaty exemption. It's not relevant to where the employer has to run the payroll. So the rules for the foreign employer registration requirements in the ROI is that usually under 30 work days, you shouldn't have to set up a payroll. So if you take on an employee and you're a Northern Ireland employer and you send that employee to work in the ROI, then under 30 days of duties spent in the ROI, you shouldn't really have to do anything with a business visitor. But as soon as you move up to 60 work days in the ROI, then you really need to be getting registered with the Irish Revenue. Now, you may not have to deduct at that point, but you need to be on their system. They need to have your details. They need to know that you're taking on a responsibility to deduct taxes should the need arise. And then once you go over to the 183 days, there is an obligation to deduct taxes on that employee who will be sent to work in the ROI. Now, these conditions are all about a situation where you've taken on, say, a Northern Ireland resident employee as the Northern Ireland employer, sent them to work in ROI. So they're not resident in the ROI. If they are resident in the ROI, then this doesn't apply. You have to set up the payroll from day one. So you've got an ROI, a resident employee, a UK or Northern Ireland employer who's recruited in the ROI to work in the ROI or is allowed to work from home in the ROI, then you need to set up payroll from the outset. And that is something that's caused numerous problems. So immediately when, say, COVID restrictions were announced and people were told to work from home, started getting these questions about, well, what do we do about our Northern Ireland employees? If they've gone to work at home, do we have an obligation to set up payroll in Northern Ireland, and vice versa for the people who lived in the ROI and worked for the employers? So what the Irish Revenue said was that if it was due to the COVID restrictions that you had to send your employee to work at home, then they wouldn't require you to set up, for an employer to set up an ROI payroll during that period. But of course, this has been going on for a while now, and the various different levels of restrictions were applied, and sometimes you're recommended that employees all work from home, and sometimes it's relaxation, you can work from home if it's feasible, and sometimes it's only essential workers that are allowed out. So there's been a lot of movement in terms of who's working at home and who's not. But the big move, I think, has been is that there's a big shift there, and it's probably going to be an awful lot more remote working as we go forward, because employers have been actively encouraged to promote remote working. So equally on the Northern Ireland side of the board, then if you've got UK or NI-based workers, then you've got an employer obligation to set up payroll in the UK or so again, there's a number of tests there. There's a 30-day, 60-day, 150-day, and 183-day test. So if you're sending an ROI, an ROI resident employer is sending an ROI resident employee to work in Northern Ireland, and they're only there 30 days, then they don't have to set up a payroll. As soon as you get up to the 60 days and 150 days, you've got obligations to get registered to make submissions to HMRC. So there's that obligation to set up a payroll from the outset. So what HMRC offered, I suppose, in the beginning of the COVID restrictions was they offered some flexibility in that regard, that they wouldn't necessarily make it that requirement, and on the number of days that you're going to be spending in Northern Ireland, you need to set up a UK payroll for that employee. But as I say, the outcome of all this is that there is an immediate sort of move towards more remote working. I mean, it facilitates an awful lot of people who maybe can move out the larger centres like Dublin and that, and live elsewhere, maybe only commute once a week or once a fortnight to their employment office, and then work from home the rest of the time. And it suits a lot of different types of employment, obviously not every employment, but quite a few. And there's a reduction sometimes in office space if the office space doesn't need to be retained for the employer. So there could be a reduction in costs. And in reality, I suppose there's a duplication in costs in some instances where offices do have to be retained, and also the remote setup costs as well in terms of say computers, security, systems, networks, etc. Some employees and employers have embraced it, some absolutely hate it. I have seen it in my own practice, and we've got a whole mixture. So for employees, I suppose in employers, there needs to be a redesign of policies for remote working. And you consider all the tax implications as well, not just the employer taxes that we've been talking about, the obligation to set up payrolls cross-border, but also the corporation tax as well. There's an issue for an employer if you have we call it a dependent agent in another jurisdiction. You're able to conclude contracts on your behalf. You can create a direct tax presence, corporation tax presence. So if you have somebody who has a good level of responsibility working from your home in Northern Ireland and you're an ROI business. And you could be creating a direct tax implication as well, which isn't subject to today's seminar, but it's something to consider employers too. We talked about the TWSS and the UK furlough and the implications there for the employers. There's some implications there in terms of policies too, because the full wage wasn't paid to the employees. There's issues that you could call out of the woodwork here, and of course, solicitors are jumping on the bandwagon in relation to some of this, and that there's issues being raised with them in relation to discrimination, unfair dismissal, breach of contract. Because if you didn't pay a full wage, even though you couldn't because the business basically suffered and you couldn't afford to, a lot of employees accommodated that. But there's others that you say, well, maybe they could have afforded to, and they're taking cases against their employer. Now, whether or not those cases will be successful, time will tell as they move through the appeal systems and tribunals and courts, because there is force majeure circumstances in a lot of instances. But I'm sure there were instances that people can cite and quote where there was a little bit of exploitation and maybe people didn't do what was required of them. And I suppose those cases will determine that. But communication is essential. So anytime you change the conditions of employment or the terms under which the employment contract is going to operate, then you need to communicate that and be open between employer and employee as to whether or not this is working, what things you require. And I suppose that's where the policies come back into it. You really should have policies around this area. We've talked about the TWSS, and the fact that the employer can top up, and sometimes they did, something they couldn't afford to, that the employer is not obliged to, but can pay the employee's tax. But if you look back on the figures, if the TWSS was paying from, say, March to the end of August, then, you could find that in gross pay terms that an employee is probably missing about a month's wages. So, there is issues there in relation to breach of contract and whether or not employees have been fully paid. But I say put everything in writing. The more communication there is, the better. At least everybody's clear on the position. Changes in working conditions as well. Health and safety rules in the workplace. But then when somebody's working from home, there might be policies needed to be introduced about health and safety and working from home as well, making sure that it's fine if it's only for a few weeks. But now that it's into the months and even longer term, we could be still having enforced working at home policies right up until maybe next summer. That's a year, more than a year on from when this whole thing started. So you make sure that the employees have the right equipment, that they're not creating health and safety issues by having the wrong equipment to work from home. There might be needs to be flexibility in hours around childcare or school closures and that. As in this continuous cycle of restrictions and lockdowns, it's difficult for employers and employees to manage. Try and plan ahead and communicate and assess the financial impact as well. Because I know that most of the smaller businesses that I would deal with is that, yes, there were some grants and some things that came in to assist the employers, but nearly all went out the door, plus an awful lot on top of it to make sure that they could keep employees working and keep them working remotely or whatever it was. So there's an awful lot of spend required on the employers as well. So it has been a whole year of flux. Say all we can do is try and do our best by the employees and see what way it goes into 2021. Now, this whole move towards remote working, this has been a big discussion topic. It's in the press, that's everywhere, I suppose, at the moment, because it has worked out really well for some businesses. I know several businesses locally that have given up their offices and said, no, we're just going to work from home. There's no point in just paying rent and rates for an office when we don't need it. They're working quite well in the type of business they're in, that their employees work from home. If they want to have a meeting, they can have a meeting, they can book a meeting room somewhere. So sometimes it works very well. I know that there, and I've been contacted a couple of times, and we've been missing each other. There's a group called the Cross-Border Workers Coalition and some other groups as well, engaging with government and that to try and get a more permanent solution in place for remote workers. And I had some thoughts on this area. I mean, if you think of Donegal, it's probably the best example to use because it's nearly cut off completely from the ROI, the rest of the ROI, by the fact that the big block of land between it and where a lot of the employment is based is in Northern Ireland. So if you've got that Derry Donegal employer-employee relationship going on, and you've got an awful lot of people who make that commute either direction. So I'd say there's at least 4 groups of stakeholders involved. There's the employers, the employees, the government policymakers, both ROI and NI. And well, some suggestions might be that the cross-border workers relief could be tweaked a little bit. At the moment, you have to be working in the other jurisdiction, and COVID recognised the fact that, well, maybe sometimes you can't. So maybe that could be made a little bit more flexible, that you don't necessarily have to be doing all of your duties of employment, but it's recognized that the employment is in the other jurisdiction under a different jurisdiction's employment contract, and just recognize that in the relief. There could be a move maybe to relieve NI employers from the full ROI payroll obligation. Say, for example, it could be a partial payroll obligation that the PRSI only is paid in the ROI, and the income taxes and that are deducted in NI, and that, along with your cross-border workers relief, might facilitate the employee, but also facilitate the employer. And from a government point of view, the PRSI is being paid in a jurisdiction where it's most likely the long-term need for that, in terms of pensions and things like that, is going to be based, where the claim is going to be made. That's a suggestion. I think it would be very important that where you have long-term remote workers in that situation, that they're not creating a permanent establishment for the employer, that there's some sort of relaxation allowed there, so that it is recognized that the remote worker doesn't create that permanent establishment to create a corporation tax presence for the employer on the other side of the border. It could be a case that you might want to limit the number of employees per employer group. So if you've got a very large organization that has a lot of ROI-based employees, or vice versa, that you might limit the number of people who can avail of that sort of relaxation in the rules. So you can't have hundreds and hundreds of them, but you might, if you've got a few, that it might work well. So maybe for smaller businesses, something could be introduced, because it is much, much harder. As we know, EURES is involved in this. You have to get the right skill set in the right area. Trying to recruit cross-border, you have to recruit cross-border to get the right skill pool for your business. So I think there's very few businesses along the border that don't have a mix of employees from either side. And I suppose the employer and the employee might need to sort of demonstrate the necessity for the arrangement regarding that it was necessary for them to recruit on the opposite side of the border to get the right skill set that they need for the business in question. They're just some thoughts I've had on the issue. But I think it's a whole area there's going to be an awful lot more to talk about. And it's a whole area that there will have to be policy changes to accommodate both sides. It's not the employee's issue, even though it does affect the employee. It's actually an employer tax issue that's causing a lot of the problems. And so it's because of that obligation to set up the payroll on the other side of the border. If that could be tweaked or relaxed in some way, then I think it would facilitate both the employer and the employee. So those are just my thoughts for the day on the subject. If there's any questions, I'm happy to take them on board. Paul? Paul, you're on mute.
Yeah, I see that there. As they say, the basic error. Unmute yourself. Rose, thanks so much for that. It's a complicated subject area. There's no doubt about it. I don't know how you get your head around it, because there are so many implications really on both sides. You made it as clear as you possibly could there, but I'm sure there are some questions coming in here for some clarity here. Let me just go up the top here now, if we can work through them. Is there any tax liability in Northern Ireland if working for a local authority in Republic of Ireland?
No, that's under Article 18 of the treaty. If you're working for a local authority in ROI, then you're considered to be providing governmental services. And so you're only taxed on that employment in the ROI. And you don't, if that's your only income, you don't have to file a return with HMRC either.
Okay, and says then if there is no tax liability, which you say there isn't in Northern Ireland because working for a local authority in the Republic, is there any paperwork that needs to be done for HMRC? It sounds like there's no need.
Well, not, if you have no other sources of income, then no other source. Work. If you have other sources of income like rental or investment or other employments or self-employment, then yes, you have to return.
The question here,
leave off the ROI employment offer, you wouldn't put it on it.
Okay. Here, one another, fire and rehire. What's the stance on this? I'm not sure.
Fire and rehire is around redundancy area and termination payments. It's an anti-avoidance measure, and if you're firing and rehiring somebody and they're claiming termination payment, which is tax relief, allowed on it, then there's an anti-avoidance measure there to say that the tax relief shouldn't be allowed if you're basically firing them and then rehiring them in a similar role. If you're firing them and rehiring them in different roles, because there's a grey area there, but you're very careful in that area as the employer, otherwise you can hit the extra taxes.
Okay, thanks for that. Just a question: will the event be recorded? It will be, and we'll send it out with the copy of the letter, Rose, as well, that you mentioned, which I think is a great idea. And we have been working in partnership with the Cross Borders Workers Coalition as well to get that message out as well, that point you made during your presentation. So if anybody's looking for any further information on that, we can help as well on that. If a company employer in Derry done this to, what's that question now I'm saying now? Okay, more of a general question here. What happens if you've worked in both jurisdictions during your working life? Where do you claim pension?
Okay, you generally claim pension in the country of residency, but that is not to say that you couldn't claim it in both. So if you've got a minimum of 10 sort of working years in each jurisdiction, you could claim partial pension in both. So say you're resident in ROI and you haven't got your full, all of your years in ROI, you've got some of them in Northern Ireland, then what you can do is you can fill in the gaps in the ROI one to try and get your full pension in ROI. And then you can also go and look and see if you've got a minimum of 10 years in NI, then you can also go and look for a partial pension there.
Okay, and that was the second part of that question. Is there a minimum number of years contributions to be made to qualify for
usually
pension?
10, usually 10.
Usually 10, okay. If anybody has they might just make sure they're on mute with a little bit of background noise there. I'm not sure if you could just do that.
Could be the fan on my laptop, it's overworked.
Oh, okay, no worries. General commentary, employers could not have picked worse time with COVID pandemic. An employer used COVID as a test to push it through. Sure what that is, okay. I'm a bit unclear on ROI payroll for an EE and NI. Would it be okay to email Rose for clarification?
Yeah, that's fine.
That's no problem. Our thanks to Rose, this is from Dawn, for covering a very complicated topic so thoroughly and for the tips and suggestions. So that's the final message I have in there at the moment, Rose. Was there anything?
Thank you, Dawn.
Yeah, no, thanks, Dawn, for that. Are there any anything like you'd add to that, Rose, at the moment?
I think it's just the speed with which changes are happening, I think has been sort of really, really difficult to get on top of. I mean, people are running payroll and trying to deal with all these schemes. I just find it impossible to stay on top of the stuff. We just have to go with it and try and do our best. There's deadlines for everything at the minute. We're just, particularly people who are advising on it, there's been deadlines for everything. We're just inundated with stuff in terms of trying to keep on top of it. Actually, really trying to help businesses to stay the course here, because there's an awful lot of businesses still in a lot of trouble. Whatever resources that were there in businesses, a lot of it's been depleted now at this point. It's been on that long. So we're going to hope now, with good news coming out about vaccines and that this thing will sort of ease a little bit and lift in early 2021 onwards, because as I say, a lot of businesses getting to the end of their tether and some won't get themselves out of it. With Brexit on the horizon too, that doesn't make it easy either.
I know, yes, exactly.
There's a lot going on in that area too, so dealing with that at the minute, and the uncertainty that keeps coming out of Brussels and London doesn't help. No,
and you get mixed messages coming out of there. Sometimes it's positive, and then the other side they say it's negative, and it's really difficult to get clarity. But look, we just have to wait and see, I think. It's imminent anyway. Something's going to happen this week, I guess, from what I'm hearing.
They haven't many days left.
No, I think today is probably their last day. But then they've said that before, and then it's rolled on. So who knows? We'll just have to wait and see what happens. Yeah, thank you for all the EURES cross-border partnerships. All updates will be on our website as they happen over the coming weeks. And that came from Joe, and thanks, Joe, for that. Will a hard Brexit affect the double tax treaty? Is a question there, Rose.
No, the double tax treaty predates all this stuff. So the double tax treaty won't change with Brexit. So something like reliefs. So an awful lot what's been going on the Brexit side is that in the ROI anyway, an awful lot of the reliefs that refer to EU and EEA, they've introduced new wording that says or the United Kingdom and everything. So that Northern Ireland is sort of covered in all those things, but the same sort of changes haven't been made on the other side of the border. So where you have a relief that sort of relies on that EU relationship, you might find that it isn't there anymore, but the treaty is. So if it's a double taxation relief, then that's still there. So anything that's mentioned in the treaty will still stand. So that the treaty, remember, is not a taxing measure; it's a relieving measure. So it's for relief that you look to the treaty.
Okay, thanks for that. And just a suggestion there, it'd be great for the Cross Borders Worker Coalition to have a meeting with you to discuss further, Rose. That was a suggestion there.
No problem, if we could just, we'll have to sync diaries.
I know. The website's there as well. We touched on in my presentation. It's EURES crossborder.eu for any information that you might want. And we're here as well to support as the representative for the region here. So please reach out to myself or Anna should you have any questions at all, and we'll try and get your answers back to you. And actually, there has been a huge increase, Rose, to the Chamber office as well for those type of questions. And thanks for your help us out on some of those as well.
Yeah.
A question here: will Brexit affect child benefit claims across border?
Oh, here we go. I might be able to answer that one.
You thought you were getting away.
At the moment, you can claim a top up. So say you live in Northern Ireland and you're claiming the benefit there, but you work in the ROI, you can claim the top up in the ROI. They've said that everything will sort of be reciprocal for the time being. That was, the very initial stages of negotiations, but I will imagine that things will change over time. So it's something you have to keep an eye on as to what you're entitled to. They did say there would be reciprocation, but they didn't say that it would last for very long. So remember that even the things that are coming out now in relation to Brexit, the Northern Ireland Protocol, it's only a 4-year life on that.
That's right.
So after 4 years, a decision has to be made. So even if it goes ahead, as it seems to be now that they've given the concession that they'll probably withdraw the internal market provisions that sort of, breached, if you like, the Northern Ireland Protocol as part of negotiation terms, and use Northern Ireland as a pawn. Then if that's the case, if they sort of throw that to one side, we've still got a 4-year time limit on that, so that these concessions for Northern Ireland will have to be decided upon in 4 years. So things will change, but just what exactly we don't know at this point.
Okay, there's another question coming here. Can an NI resident working in Ireland claim married tax allowance?
An NI resident working in ROI can't claim married tax bans or credits through the payroll because it's meant to be taxed as a single person throughout the year. But at the end of the year, they can put in what's known as an aggregation claim. So they can recalculate their taxes on a joint assessment basis and send that into the Irish Revenue. If they're better off that way, they'll get a refund.
Okay, brilliant. Thanks very much. Another question here. Currently, it is possible to transfer an ROI pension into a qualifying UK scheme. After Brexit, will this still be possible?
Ooh, the pension's not my area.
Okay, another day, another dollar, as they say. We'll have to put something on that. I mean, it is a minefield, I guess.
Oh, I would check with the pensions advisor, a QFA or whatever in the south, is where you can do that. Yeah.
Okay, right. Okay. And I think that's the last one I have there now, Rose, at the moment. And I think I've answered anything else. If there's anything else you'd like to add yourself, Rose, at this stage?
No, it's just, I say, it's constantly changing. So just keep an eye on what EURES are putting out there and the stuff that's in the press as well. Just send queries through. And particularly if it's immediate and that you needed to know it for taking on a new job or something like that, then we'll send the queries through to EURES. Yeah.
Brilliant. Could I just ask you to stop sharing your screen there? I just wanted to put up a Word document for myself here. Thanks. Thanks very much, Rose. Just to summarise then, today, look, on behalf of the Chamber, I'd like to thank Rose for her expert advice again and support during these challenging times. Look, it can be sometimes difficult to know where to access information that you need, and that's what we at EURES, through our partnership with them, endeavour to deliver. If you have any further queries or questions that we've not covered, please forward them to myself or Anna, and we'll try our level best to connect you to the information you may need. And our Chambers really greatly appreciate your continued support. So many thanks for joining us today, and I wish you all a great afternoon. And thanks again, Rose, for your time.
No,
it's been really informative, and we look forward to talking to you soon.
Okay.
Thank you. Bye now.
Bye now.
Bye.